Let's move on to a financial company, a banking company. We're talking about Key Corp. Symbol is Key, Key. They're in the regional bank industry, only 3% short on the float there. 89% institutional owned. Disappointing, no PE ratios. It means they have no earnings over the last 12 months. Industry's at 9.7. Price to sales looks high too, 3.9 versus 2.7. Price to book value, 1.2 versus 1. And price to cash flow for Key Corp is 110 versus 43. The only good thing, well, it's even not that great. PEG ratio 0.6, which is good, but the industry's at 0.1. And I kind of know Key Corp. I know we've looked at buying this in the past, so I'm kind of disappointed so far in the numbers. No earnings per share growth, but the industry was down 40.2%. Sales were down 22.3% for Key Corp versus an increase of 1.6 for the industry. The 5-year earnings per share growth estimate from the analysts is a positive 21.2, double the industry at 9.6, so that is good. You get a nice dividend, 4.5% yield, but the payout ratio not material because they don't have the earnings to pay out the dividend dividend per share, 82 cents. They don't have that income right now. We do see on the balance sheet, it's a financial company, so no current ratio. Debt to equity looks good, 0.8 versus 1.2. Net profit margin, 0.5 versus 28.3. Return on equity is a negative 0.6 versus positive 10.9. And then free cash flow is $102 million versus about $2 billion for the industry. So financials a little bit weak. What do you got, Chase?
There's a current price here for Key Corp. It's $18.33. The 50-week range, the low here, $12.73, and the high, $20.04. Year-to-date, the stock's done quite well. I'd say quite well, up about 7%. So that's about matching, I'm going to say, the market. Over the last 1 year, though, it is up about 21%, so done well over that time period. Going forward for Key Corp, though, we go out to December 2026 again. Estimated earnings per share of $1.75. That gives us a target sell price here of $29.05. And what kind of prompted the interest here is that they actually did receive an upgrade from UBS saying that they have superior capital arsenal, strong loan growth momentum, and the potential for net interest income upside surprises. Key Corp has been interesting to me because it is a smaller regional bank compared to your large money center banks, which I believe will benefit more under the current administration due to less regulations. I think that should help their expenses. Kind of looking at the company, though, I thought, hey, maybe, these smaller banks would be consolidation targets. I think they would be a acquirer rather than acquiree.
Really?
Their market cap is about $20 billion, so it's a decent sized bank. I think it'd be hard to acquire a bank of that size. So, not that I don't like it because of that reasoning. I think they do have, again, good opportunity for growing earnings because of less expenses under the regulatory regime and, again, loan growth. So I think it's interesting. I think there is possibility here for a good investment in Key Corp.
Yeah, the numbers do look pretty good, and I do look at the range. They're pretty tight, $1.63 to $1.90 for that 2026 earnings year. But it's still in the back of my mind what happened just a couple of years ago with the regional banks. That a lot of them showed that, wow, they had some problems. And we're still not sure on the real estate market. Rates seem to be saying high. And again, we keep telling people this. If the Fed cuts rates, doesn't mean mortgage rates will come down. That's based on long-term rates. And that's more on supply demand. So that can hurt these banks. Because I believe your regional banks do a lot of mortgage lending.
Well, an issue that they ran into before was they had to carry the treasuries on the balance sheet, and when rates shot up, the problem was the bonds on their portfolio went down, and it caused potential solvency issues. Yeah. I think under this Fed supervisor with Michelle Bowman, I think they've talked about removing that requirement or looking at that differently because these banks aren't going to sell those treasuries. Right. So that's where I kind of think there is opportunity within these banks because of the new regulatory regime. I did look at 2023 during the banking crisis. This thing did fall as low as around $9 a share. So, yeah. I mean, congratulations if you had the wherewithal to step in during that difficult time period.
I think we did look at that, and I was kind of excited about it back then at $9, $10, $12 a share, and it was one that I thought it had potential.
Because I remember the CEO talking, we're not worried at all about the banking crisis. Now, most CEOs aren't going to go on CNBC and say, oh my God, we're going to fail. But he seemed very strong, and he had some good facts to back it up. So I remember looking at it back then and saying, yeah, I mean, it made sense, and it appeared to be one of the safer regionals at that point in time.
Yeah, well, that's where we stand. Not bad, but not as good as it was. But let's